Good evening, everyone, and welcome to today's Young Alumni Virtual Chat, Purchasing Your First Home, brought to you by the UMass Amherst Alumni Association. My name is Nicole Young, and I serve as the Assistant Director for Young Alumni and Constituent Programs for the Alumni Association, and will be hosting this evening's session. Before we begin, a few housekeeping items. All participants will be muted throughout the presentation in order to reduce background noise. This virtual chat will be recorded, and the recording will be posted to the Alumni Association's YouTube channel in the coming weeks. By joining this session, you are giving your consent to such recordings. We have a limited amount of time, so we will save Q&A for the end. As this presentation is taking place, if you have a question, please use the chat function to send your questions to me. I will compile your questions, and our panelists will answer at the end of the facilitated conversation. And now, without further ado, I am very excited to introduce tonight's guest speakers. Susan Seaver, our first presenter, serves as the Vice President of Mortgage Loan Officer for Florence Bank. Sue has been with Florence Bank for 3 years and has worked in the industry for 28 years. Prior to Florence Bank, she was with People's United Bank and Citizens Bank, having consistently won top producer awards with these lenders. In 2017, Sue was honored by Mass Housing as a medal winner for originators. She currently serves on the Realtor Association of Pioneer Valley's Community Service Committee. She loves spending time with her family and enjoys helping people realize their dream of home ownership. Our second presenter, Diana Adair, works for Sawicki Real Estate based in Amherst, Massachusetts. She recently made her return back to the real estate business after selling her own business, Heartland Farm, which she had for over 20 years. Diana is a member of the National Association of Realtors and holds the Graduate Real Estate Institute and Certified Residential Specialist designations, along with a Massachusetts broker's license. She began her career in real estate in 1986, working for D.H. Jones Real Estate in sales and some management. Diana is based in Amherst, a place she's called home for nearly 40 years. Thank you, Sue and Diana, for contributing your time this evening to share your knowledge on this very important topic. So our first presenter, Sue, we're going to go ahead and turn it over to you.
Well, thank you, Nicole, and thank you for inviting me to participate in the path to purchasing your first home. Just see there we go. If you want to advance the slide, my contact information is there. Once you've decided to explore the possibilities of home ownership, it's important to not only determine the amount you feel comfortable spending, but to make sure a bank will lend you the money. And unless you've got unlimited cash, most home buyers will need to obtain a mortgage to purchase a property. So I hope to help you navigate the mortgage process, starting with a pre-qualification. Next slide, please. The pre-qualification is something that is particularly important in a competitive market that we're seeing right now. What a lender does is verify your financial information, such as your income, debts, and credit score, and provide you a written estimate of a loan amount that you qualify for. It's not a loan commitment, and it's not for a specific property, but it does give you a very good idea of what you qualify for. There are some different levels of pre-qualification. I just want you to be aware. Some lenders will be just running numbers and giving you an estimate, but others take it a step further, and I think it's important to differentiate what your lender is offering in a pre-qualification. Are they running your credit report? Are they actually analyzing what programs are best suited for you? The other term, pre-approval, you may hear in this process, and there are lenders who would actually offer a pre-approval that is directly goes to an underwriter rather than the loan originator, and they are certifying and verifying all of your information just without the appraisal on the property. So that is probably the higher level of a qualification. Not all lenders offer, but it's good to ask your lender what constitutes their pre-qualification. The pre-qualification does give you an opportunity also at the beginning of the process to review your credit, make sure that there's no incorrect information on the credit report, take care of any collection accounts, anything that might show up, any negative credit that might show up, and shop for the best loan programs prior to actually negotiating a contract to purchase. And it's my experience, and I'm sure Diana would agree, that most real estate agents are going to require you to have a pre-qualification letter when you're making an offer because of the competition. And it also shows the seller and the real estate agent that you're able to obtain a mortgage. The seller does not want to take their property off of the market only to find out that the potential buyer can't get approved for a loan. That wastes their time, and also you don't want to find the perfect house only to be disappointed that you can't get the mortgage. So the pre-qualification, like I said, has become, I think, an important first step in the loan process. What information, next slide, please. The information that's required for the pre-qualification is very similar to what you're actually going to need to submit for the actual mortgage application. So it's not a bad idea to try to gather this information ahead of time, maybe keep updated documentation, so that you have it at the ready. The sources of income that we're going to need to document: pay stubs for your most recent month, your last 2 years W-2 forms, last 2 years of federal tax returns with all the schedules may be required if any of your income is derived from self-employment or commission income. And any other type of income that you have must be documented. Your asset statements will need the most recent 2 months bank statements for all the accounts that you expect to be utilizing funds from to cover the down payment and closing costs. Next slide, please. What is a lender looking for when assessing an applicant's ability to purchase a home? Something that's been categorized as the 4 C's: credit, capacity, capital, and collateral. Let's take a look at each category. Next, please. Your credit. Have you demonstrated financial responsibility with debts? Lenders typically are going to pull what's called a tri-merged credit report, which includes scores from TransUnion, Equifax, and Experian. These differ from the reports that you are typically able to access on your own, where you may not be able to get credit scores, or they may only be giving you 1 credit score instead of 3. We're using the middle score for mortgage purposes. If the application is a joint application, we will use the lowest middle score, depending upon which borrower has that. The other minimum monthly payments are used from car loans, personal loans, credit cards, and student loans. Utilities, other type of things that you might consider debts are not necessarily the debts that we're looking at in the mortgage process. If you have any court-ordered alimony, child support, that's also considered a debt, and we would need to document that. One thing that's important, particularly on student loans, if your student loans are deferred currently, we do require to either verify what your future payment is going to look like, or we have to use 1% of what the outstanding loan balances are. that could actually be significantly higher than what you're required to or will be required to pay back, particularly with the income-based repayments. So that's important, and I think helpful when you're doing the pre-qualification. If you have parents paying student loans, we would have to prove that they've paid the loan for at least 12 months from an account that does not have your name on it. If you could document that, then we would not be required to count that in your debt ratio. Next slide, please. The capacity. Do you have the ability to make the new monthly payment? Sources of income that we're going to use for qualification. We'll use your full-time job, or which is considered your primary occupation. It doesn't necessarily have to be a 40-hour job, and I know a lot of times full-time isn't necessarily 40 hours any longer. It could be 37 and a half, it could be 35, but it would be what's considered your primary occupation. If you also have a part-time job, we can use that as long as you have a 2-year history. So part-time income, we would need a 2-year history. Self-employed income, also we would have to document a 2-year history via tax returns. Overtime, bonus, and commission income can be used. Again, a 2-year history is required, and we would be averaging that income over the last 2 years. If you're receiving alimony or child support, that income can be used for qualification, provided it is court ordered and that we have a 3-year continuance. Social Security, pension, any other type of income that you may be getting also requires that we determine that it's going to continue for at least 3 years. Projected rental income. If you were purchasing a multifamily, we can use the rental income not on the unit that you'd be occupying, but on other units. And I just want to caution you that on some programs that have income limits, the rental income on the property that you would be purchasing is also added into your income. So it can affect your ability to get particular programs that have income limits because we're counting this additional rental income. Next slide, please. Capital is your savings, the funds that you have available to use toward the down payment. So the funds are required for the down payment. First-time buyer programs typically are going to require between 3 and 5% of the purchase price as a minimum down payment. There are some zero down payment programs available, also called 100% financing. And those programs also typically have certain requirements, such as you're a veteran and you'd be able to get a VA loan. Or if you're purchasing a property in a rural community, USDA may be available. So some of those programs have income limits, geographical limits. Those are the type of things that you want to discuss with your lender and see if there's any programs that are best suited for your particular needs. You'll also need to have funds to cover closing costs, and I'm going to go through those a little bit later. Also know that when you're negotiating your offer, a seller can pay some of your closing costs. That varies from program to program, the amount that the seller is able to contribute toward the closing costs. But it is helpful if you're short of cash, don't have, you have the down payment, you may be able to get the seller to pay closing costs and eliminate some of the total cash that you would actually need. Also, prepaid expenses you are going to need to have funds for. They're not technically closing costs, but because you are most likely going to have your real estate taxes included in your monthly mortgage payment, a lender typically has to collect between 3 and 6 months of these real estate taxes at the closing to establish your new escrow account. And that can be a significant amount. Homeowners insurance. Your first year premium of homeowners insurance has to be paid prior to closing. So even if you are going to have that also included in your monthly payment, the first year always has to be paid in full. So all of those things add up to the monies that you're going to need for the transaction. I also put reserves on this slide. Some programs, not all first-time homebuyer programs, that is a benefit of some of the first-time homebuyer programs, but some require that you have 2 months of the mortgage payment left in the bank after the closing. And that's just in case, just as a buffer, worst case scenario. They want to make sure that you have something should you have a expense that, let's say the house needs some repairs that come up that you weren't planning for. Your mortgage payment, at least you would have something in reserve so you'd be able to make that mortgage payment. Next, please. When we're talking about funds for the transaction, I gave you a list of what's acceptable funds that we need to verify: savings, checking, certificates of deposit, stocks or mutual funds. You may be able to use funds from your 401k, either a loan or could be a withdrawal. Gifts from family members that we can document and have a paper trail are allowed. Unacceptable funds, mystery cash. People actually keep cash at home, and I know that's in some cultures actually more prevalent than others, but we have to be able to verify where that cash came from. Any undocumented large deposits, borrowed funds, cash advance on a credit card, those funds we're not able to accept as funds to utilize for the transaction. So I always caution people that if you have any funds at home, you don't want to just deposit a large amount into your checking or savings account just prior to going to apply for a mortgage. We are going to ask you for at least those 2 months of bank statements for documentation, and any large deposits that show up on those statements, we're going to require explanation and proof of the source. So I would suggest anyone that has cash that they need to deposit into their account, you're going to want to do that at least 3 months before applying for a mortgage so that those large deposits don't show up on your recent bank statements. Next, please. And the last, the collateral, is actually the property. The lender is going to take a lien on the property, none of your other assets. But how we determine the value of that property, the lender is going to order an appraisal. The appraisal is a sales comparison of 3 similar properties that have typically closed recently in close proximity to the property that you're purchasing. It's not an inspection report, and I know Diana will go over inspection reports, but the appraisal is a sales comparison. The lender is going to use the lesser of the sale price or appraised value to determine what's called your loan to value. And program guidelines are going to determine this maximum loan to value. Typically, I would have to say properties that I see listed with a realtor, I don't want you to get too concerned that the appraisal is not going to come in at value. It does happen, but typically when a realtor has listed a property versus a for sale by owner, they've done a market analysis, which is very similar to what the appraiser is going to do, and compared recently closed sales. And again, I'm sure Diana will speak a little bit more about that. Next slide, please. The qualifying ratios can vary from program to program, but in most cases, your total monthly housing expense, the PITI, you'll see it abbreviated, plus your monthly debt payments. These are the minimum monthly debt payments that we talked about for credit cards, car loans, student loans, etc., should not exceed 43% of your gross monthly income. That's a very standard guideline. Now, some, again, programs do vary, but I think that if you're looking at that 43% of gross monthly income, you're going to be in the ballpark for approval. The principal, interest, taxes, insurance, also to include private mortgage insurance, homeowners insurance, and if by any chance you're looking at purchasing a condo, the condo fees. Those are all considered part of the PITI, your total housing expense. Next, please. Private mortgage insurance. Private mortgage insurance is the insurance premium that the borrower normally pays when the down payment is less than 20%. The insurance protects the lender against the losses in the event of foreclosure. It doesn't protect the borrower, but it is required, and the borrower typically is going to have to pay that if they are putting less than 20% down. The private mortgage insurance costs do vary depending on the amount of down payment, your credit score, and the type of loan. Some of the government loans have mortgage insurance that are upfront, can be rolled into the loan amount, but each program has its own requirements for the private mortgage insurance. Some programs allow you to actually pay a higher rate to avoid the private mortgage insurance, or to pay a one-time premium up front rather than pay the private mortgage insurance monthly with your mortgage payment. Some of those upfront premiums are not refundable, but they may actually help you qualify for a higher mortgage because you're not going to be paying that private mortgage insurance with your monthly payment, and it would not be required in the qualification process. Next, please. Different types of mortgages, particularly categories broken down: the fixed rate mortgage, where you're going to pay the same interest rate, the same monthly payment of principal and interest for the term of the loan. Most first-time buyer programs are for a 30-year term, which is actually going to help keep your monthly payment lowest because you're stretching it out for the longer term, for the 30-year term. There was a small point in time where 40-year mortgages became available. I haven't seen any lenders actually offering a 40-year term. I think those went by the wayside. If you're looking for an adjustable rate mortgage, where your interest rate is adjusted periodically according to a pre-selected index plus margin. Some of those indexes that are typically used by lenders are the Treasury Index or the LIBOR Index. There may be some other ones, but those are the most popular indexes that a bank uses when they're setting their adjustable rate mortgages. The interest rate adjustment can change your monthly payment, and there's going to be specific terms set out prior to that are going to determine when your rate is going to be reviewed, how much that rate can go up or down at any adjustment period. And I know it sounds a little scary, but there are reasons why someone might take an adjustable rate over a fixed. You may be able to get the benefit of a lower rate for, we'll use, for instance, an adjustable rate product where the rate is fixed for 5 years and is going to review annually after that. But if someone has plans only to stay in the property for a short period of time, you may again be able to secure a lower rate for taking an adjustable. Next slide, please. Purchase and rehab mortgages, some specialty programs that may be available that allow you to actually borrow funds not only to purchase a home, but additional funds to renovate or repair. Not all lenders offer these particular loans, and qualification criteria does vary. But it is something that if you are looking at a fixer-upper, these programs can help you not only purchase the home, but also get the monies for repairs. In addition, some lenders offer construction loans to purchase the land and construct a brand new home. These loans typically require a minimum of 20% down and additional reserves. So they are for a borrower that has a little bit more financial stability and resources. And typically the credit score requirements are a little bit higher on those loans. Next, please. When you're comparing mortgage terms from lender to lender, and I didn't mention, but I just want to point out, you can get a pre-qualification from one lender. That doesn't mean you have to get the mortgage from that lender. You could certainly shop around. A lot of people start with the bank that they have their checking and savings account with, but also shopping different programs. Realtors are a wealth of knowledge too. Your realtor may have some information on programs that have worked well in the past for their buyers as well. But when you're comparing mortgage terms from lender to lender, you want to ask them some specific questions. Do they charge an application fee? Some lenders will charge an application fee, some will not. For instance, Florence Bank, we don't charge an application fee. The only money that we would collect up front is the cost of the appraisal and credit report, and those are deducted from the total closing costs. Another, comparing the interest rate with the annual percentage rate. You'll see APR expressed as a rate. The annual percentage rate is the cost of credit on a yearly basis. It takes into consideration fees associated with getting that loan versus the actual interest rate that your monthly payment is going to be based on. When you see a big difference between your interest rate and the annual percentage rate, that would signify that there's either exceptionally high fees or you're paying points and private mortgage insurance. All of those things are considered included in the annual percentage rate. So you want to look at those and compare. The other questions, rate lock-in period. When can you lock your rate? Can you lock your rate at application? How long is the rate lock period? You certainly don't want to sign a contract that says you're closing in 90 days, apply for a mortgage where your rate lock expires in 60 days, and then you're left hanging and vulnerable if rates go up. So you want to know what a bank's policy is on their rate lock. Do they collect a fee to lock in the rate? Some do, some don't. Florence Bank does not collect a lock-in fee, but there are lenders that do. Are you paying any points or pricing adjustments? Fixed rates in the secondary market tend to have pricing adjustments that are a combination of your credit score, down payment, the type of property that you're purchasing. So you want to make sure that when a lender's advertising a rate, are there any adjustments to that rate based on those specific criteria? A lot of the first-time homebuyer programs may not have these pricing adjustments, and that's another benefit. If you're qualifying for certain programs, you might not be subject to those points or pricing adjustments. You'll also want to ask what the down payment and eligibility requirements are. And I would say use your lender's help for that. When I'm talking specifically to a customer and I'm trying to determine what programs they qualify for, I'm not going to go into the details of all the programs that they don't qualify for. I'm certainly going to give you a rundown of what I think would most benefit you, what your income and credit scores qualify you for. So I'd say take a cue from the lender and help with the shopping and narrowing down the programs that would actually fit your specific needs. And also the closing cost estimates. You want to compare. Banks and mortgage companies tend to have some different fees. And the next slide, please. As far as closing costs, what do the closing costs comprise of? The total cost of expenses incurred when transferring the ownership of a property from the seller to the buyer. The lender fees can include points, and 1 point is equivalent to 1% of the loan amount. So you may be paying points in order to get a lower rate, but you also may be paying points just as a pricing adjustment to the product. Other lender fees, origination, processing, application fees, and in some cases, a mortgage broker fee. Those fees can differ, obviously, from lender to lender. The third-party fees, attorney, title insurance, your title search, credit report, appraisal, tax transcript fee, survey, and recording fees. These are fees that go directly to these third parties. They may vary from lender to lender, but for the most part, they're actually not set by the lender. So these are whatever the third-party vendor is charging. You'll see these particular fees. And then prepaid expenses. These are, again, not necessarily closing costs, but it is monies that you have to have available for items used to set up an escrow account, such as the real estate property taxes, your insurances. So when you're adding up all the funds that you need, those are some of the categories that you'll want to get estimates for. Next, please. Once you do find a property, the loan application process, you'll have dates by which you need to notify the seller that you have an approved mortgage. The first step, you're submitting your loan application with the purchase and sale agreement and the other supporting documentation that we discussed, like your W-2s, pay stub, bank statements, and such.
You are going to see on my screen with my photograph on it that I am Diana Adair, Realtor. Realtor is a term that is a registered collective membership mark that identifies real estate professionals who are members of the National Association of Realtors, of which I am one, and we subscribe to a strict code of ethics. Our membership in the National Association of Realtors is composed of residential and commercial brokers, salespeople, property managers, appraisers, counselors, and others engaged in the real estate industry. Oftentimes bankers and attorneys and building inspection service providers will also be members of the National Association of Realtors. And part of the reason for that is the respect that they have for this organization, who started off with a mission and a vision statement that they would work for America's property owners. The National Association of Realtors provides a facility for professional development, research, and exchange of information among its members and to the public and government for the purpose of preserving the free enterprise system and the right to own real property. The National Association of Realtors has a very large, very powerful RPAC that protects our right to our property. And indeed have been strongly invested over these last several months in something as important as our new tax guidelines, which I'm sure some of you are interested in and have read about, in terms of how deductible our mortgages are on our properties. I work in Amherst, Massachusetts, where the University of Massachusetts is, and I sell some commercial, mostly residential, and new construction and land throughout Franklin and Hampshire County. Next slide, Nicole. I wanted to thank Nicole for inviting me this evening, and I invite you to ask your questions at the end. First-time home buyers are a very large client base for me and have been oftentimes over the years. At our first meeting, there is a mandatory law that a realtor must disclose to you that we are obligated to you by the state of Massachusetts to provide you with honest expertise. You'll hear my paper rattling. I'm going to read it off to you. If you are a buyer or seller and you engage a real estate licensee to provide advice, assistance, or representation to you as your agent, the real estate licensee can represent you as a seller or as a buyer or as a facilitator through that transaction. That licensee, regardless of the working relationship with you, must by law present properties honestly and accurately and disclose known material defects in the real estate. So at our first meeting, I am going to hand you a document that explains all of those issues to you. It is not a contract. It is simply informational for you, and I am required by law to present it to you. There's a lot of real estate in the there's a lot of paperwork in the real estate business. Everything from this disclosure that we've just talked about, that will be the first one. When I first meet a new buyer, I often put together a package of the many documents that you will see and most often be asked to sign. We will talk about the offer to purchase as we get a little further into my presentation. That is certainly something that I will provide you a document for in your beginning package. There are lead paint laws and seller's description of property documents that come oftentimes with a home that you're going to perhaps see. We oftentimes ask our sellers to fill out those documents so that you have an idea of some of the history of their ownership of the home. They may very well provide you in that document who their plumber was, how old the furnace is, how much fuel do they use, any improvements that they have made. Maybe the bathroom is updated or the garage door was changed. Maybe there's a swimming pool, and they will talk about that. They will talk a little bit if you're looking at condominiums, then the seller will provide you with some of the information regarding the condominium as well. As we start to talk about actually going out and looking at property, looking for that property that you have decided you're going to purchase, the things that I am going to provide you with as we journey through each one of them are a listing sheet, a GIS plot plan, a seller's description form, if indeed that seller has lived in the property. If the seller is an investor and has never lived in that property, very often we will not see a seller's disclosure form. Again, you're going to see that offer to purchase, a lead paint disclosure. There is a lead paint law in the state of Massachusetts, and it's important for you to know how that law is written and the responsibility, very strong responsibilities that all of us share in a lead paint disclosure. If that property is built before 1978, then we are required by law to have the seller disclose anything that they might or may not know about whether or not there is lead paint in existence in that property. And it is our responsibility to provide you with that document that the seller has signed. If you have small children, it's very important that it's very important for you to be knowledgeable about this lead paint law. I think most of us are aware that there is a danger to small children where lead paint is loose and broken and in the house in any way, shape, or form. One of the options that you have is one of the inspections that we're going to talk about. And in this seller's disclosure, you may very well learn that that seller has already done that inspection. It is not a required inspection by law. It is a choice that is oftentimes done by the homeowner. Next slide, Nicole. I think you should know at your initial meeting with myself or anyone who sells real estate that we will welcome your questions about who we are, how long we've been in the real estate business, what is the level of our experience, what are our qualifications for being here, what your expectation can be of the service that we are going to provide you. I'm going to counsel you that there are any of a number of qualified experts that you may need throughout the home purchase. I'm going to provide you with a number of attorneys that you might shop and call upon and have a discussion with about what your needs are going to be throughout the closing process. One of the things that an attorney does, we've just heard Sue talk about documents and getting to a closing date. One of his jobs, his or her jobs, is a responsibility to close the loan for the bank and for you. You are going to start with that attorney, probably with your offer to purchase, especially if you have something that is a little complex with the property, and you may have a question of that attorney. And that attorney and I may very well have a discussion as well, because he or she is going to have questions of me. If for instance, there was an issue with lead paint, we would want our attorney to know that up front. I'm going to give you a list of building inspection service providers. And nowadays, building inspections are very detail-orientated. Building inspectors do not just go in and turn on the furnace or turn on all of the lights or check out whether or not the dishwasher runs, check and see whether or not the roof is good, give you some advice about what the longevity of that roof is, whether or not the swimming pool is working, whether or not the filter is working, the quality of the workmanship throughout the house, those things that you may very well anticipate will need to be repaired or replaced, and a discussion of that. These building inspection services now also do a termite inspection, if you will. So they inspect for termites and other wood-boring insects and any damage that was caused by them throughout the property. They will also do a water test for you, so that if you do not have town water, and even if you do have town water, you may very well know what the value of that water is, what's in it, is it good water, is it good drinking water. But if you do have a well, then that building inspector and myself will advise you to do a water potability test and to check for bacteria and so on and so forth in the well. If there is such a thing, it can very often be treated, but it's something that you want to know about. They are also now doing things like mold inspections and mildew inspections. And I'm sure that any of you who have started out on the process toward home buying have heard of radon, and they will also do radon air quality testing for you. And there are a multitude of different ways to test for many of these things, your radon, your mold, your mildew, and so on and so forth. So that there is a plethora of those things that we will discuss as we go through our property search. In terms of many of these professionals that I am going to make recommendations to, I work with many different people, and so I normally have a list of 2 to 6 various and sundry professionals in each one of those job descriptions I've just spoken about. And one of the ways that you can also decide on utilizing someone, especially if you're new to the areas, is if you know somebody who has recently bought a home and they felt happy and satisfied with the information they were given by the experts that they used, then ask them for a recommendation for that person. Next slide, Nicole. One of the best things about being a real estate agent is the discussion about defining the needs for your home, what you need in your home. What are you hoping to buy? Um, as I have said before, many of the buyers that I'm working with are purchasing their first home. As Sue has spoken to us about, one of the most important things that I will ask you to do if you haven't done, and most other real estate people will do the same, and that is to invite you to definitely go and visit your lender, your bank. Maybe it's your local bank. Now we have my friend Sue. You may not necessarily, as Sue said, borrow the money from that lender, but sitting down to talk to somebody who is a professional and providing them with all of the information that Sue has given you a list of, and talk to you about what you can afford to spend. In other words, what the bank will lend you. Sometimes you get the happy news that you have very nice credit and that you can go forward, and they will lend you a whole lot more money than you ever dreamed they were going to lend you. So part of what we will have a discussion about is, what are you comfortable spending? Because that's where I want to start, is what amount of mortgage money, what amount of purchase price are we actually looking at? If you can afford to buy a $500,000 house, but you don't want to have a mortgage that large, then let's start at a more comfortable place. So you want to talk a little bit about that. Once you've met your lender, kick it back and forth and give some real thought to, how much do we want to spend? What kind of monthly payment are we going to be comfortable with? I think we can move on to the next step, Nicole, the next slide. So some more of the questions that need to be answered before we actually search is, and this is a big one, choosing the location that's going to work the best for you, either to service your needs, or because your family lives there, or because this is a community that you have visited and that it is a place where you want to live. Maybe you work within this community, or your commute somewhere else is easily accessed from this community. Maybe this community is a little less expensive than another community is, and so that is part of your decision-making process. In this Amherst area, we have communities around us where the property taxes on single family homes, on all property, is a little less money than some others, and that is certainly a consideration that you're going to be looking at strongly, because you're going to divide that tax bill up into your mortgage payment in many instances, and there can be a dramatic difference in what you would pay for a 3-bedroom, 2-bath ranch with a 2-car garage, what the tax assessment for that property is from one community to another. So I always recommend, especially if you're coming to a new area, if you're buying in your community, you already know most of these things, but explore your community services. Explore schools. How far away are schools? Do your children go to the elementary school all the way up through high school in that community? In the communities that I work in, I live in Amherst, and so we have the Amherst Regional School District. And so other communities around us, Leverett, Shutesbury, and Pelham, in the middle school and into high school, those children come from those communities and go to school in Amherst. All of those communities have their own elementary schools, but their secondary schools are here within Amherst. So that's something to give some thought to. You want to know about taxes. When I talked a little bit about that, what is the tax rate? What can you expect your taxes to be? Do you have full-time police and fire services? I work in Western Mass. There are many small communities, and many of our firefighters are volunteer firefighters. And we have a somewhat smaller police department in some of our outlying communities. What is your distance to work? We spoke about location. What are the amenities that you are wanting to be reliant on? Are you close to a hospital, doctors, shopping? So think about the communities as you drive through them and where you are and how comfortable you are with that location. It is the only thing that you can't change. Obviously, there are many types of homes, many sizes, size, shape, color, and condition. And condition is a big one when you're going out to shop for your first home, because you should think about repair. Sue talked a little bit about repairs and improvements and so on and so forth that house may need, and how you would finance those things. Are you handy? Are you looking for something that maybe you can buy for a little less money and then fix it up? Do you have the ability to do that, or could you afford, either through savings that you already have or in time and patience in fixing it, if you could purchase it for a little less? When do you want to move? When do you want to move is something that I try to always remember to talk about, because oftentimes we could encounter a seller who is motivated by an offer from a buyer who can purchase when they need to move. And it can oftentimes in a listing sheet information be stated that the seller does not want to move until the end of the school year, so not until the end of June, or that the seller can be, or oftentimes the seller tells us nothing about when they want to move. So for you, if you have a need to move, if you have to be somewhere and your children have to be in school, or you have to take a job and you're going to lose your lease on your current living situation and you have a need of moving, then that's something that we should talk about in the beginning. Next slide, Nicole. I'm going to provide you with a multitude of, I'm being told that you've lost me. Nicole, can you hear me at all?
Sue, I can actually hear you. I'm sorry, not Sue, Diana, I can actually hear you.
Okay, good enough. I just got a text message from Sue who said that she had lost me.
Okay, and then someone
Alrighty.
else just stated that they can hear you as well.
Okay, good. Alrighty. I was starting to talk about, again, various and sundry documents, and these are documents this next group of documents I alluded to somewhat, is when we go out, you're going to have listing information, and a listing sheet is a pretty nice start to the questions that you're going to have. It's going to talk to you about square footage of the home. It's going to talk to you about square footage of the land. It's going to talk to you about the heating system. It'll tell you about number of bedrooms and bathrooms. How many rooms total are there? Is there a garage? It will let you know sometimes that the seller is aware that the roof needs to be replaced. It'll let you know that the septic system failed a Title V inspection and it needs to be repaired, and that it will or will not be done. It will tell you what the property taxes are on that property. It'll let you know oftentimes whether or not things like kitchens and bathrooms have already been updated. So it's awfully nice information. I oftentimes provide a plot plan so that you know how the house sits on the property, um, and those are easily accessed through for most communities through GIS maps that you can access right online. A tax card is pretty valuable in that it tells you how long that Sue is still telling me that she lost me, but I'll go on. A tax card, one of the best things about a tax card, and they are accessible through the assessor's office in many of the communities that you're going to be shopping in. And one of the nicest things I like about a tax card is that you will learn if the seller has made some improvements that needed to have a permit for those improvements from the town. Things like plumbing permits and electrical permits, and they will have to get a permit when a new furnace is installed or a new roof is put on, or when the family room addition was built or the garage. And so a tax card can be kind of a valuable document. And again, it is available to you right online through the community assessor's office. If you're shopping for a condominium, then there are a group of condominium rules and regulations. You'll want to know about where does your condominium fee go, and what does it cover should you purchase a condominium in that particular condominium complex. Another document that a lot of us don't think about. I bought a home years ago in a newly developed neighborhood. I had never heard of condo documents, of deed restrictions rather. And so neighborhoods are often developed by one development company, and the homes in those neighborhoods may very well be built by several builders, but the development itself was permitted through the community, and it has deed restrictions. And so you want to know what some of those deed restrictions are. You may very well fall in love with a house that you absolutely positively can't live without until you find out that you can't park your boat there. So you want to know some of those deed restrictions, and there is oftentimes a homeowners association fee that is paid to that neighborhood. So again, there's much information that's applicable to the purchase that you do. Sue started to talk a little bit about pricing and so on and so forth, and about this very busy marketplace that we are involved in. Your realtor should be someone that you can look to be knowledgeable about what is happening in the marketplace in the service area that they are in. Regarding pricing, terms, conditions, inventory, or lack thereof of inventory, which we're experiencing in many of the communities that I do business in at the moment in my area, because it has been a very strong buying marketplace. The economy is good. People were somewhat at a stalemate for some years up until, probably about 2.5 or 3 years ago, and then got a little bit more confident as the unemployment rate fell and the economy got a little bit better, and the interest rates had held to the rates that you see now. So there is a very strong buyer and of course seller marketplace, and pardon me, need a little drink. So one of the things that you're going to depend on from your real estate person is to talk to you very strongly about what is available in the marketplace, what your expectation is in terms of making an offer, how they'll talk to you about pricing. You remember that if you are a buyer's agent, if I am your buyer's agent in this instance, then I owe you and I'm obliged to talk to you about about what is comparable to the things that we're looking at. If you find a house that you think is the perfect house for you, what are the other past sales in that area, in that size property, with that number of bedrooms, with that number of bathrooms, and in that condition? What have past sales been? And that is information that we provide regularly to home buyers. Again, we talked a little bit about terms in terms of when do they want to move. What are the terms? What are the terms available in various and sundry programs, first-time home buyer programs, and mortgages available through the local lenders? And again, that condition of the marketplace throughout these past 15 months, I have sold 5 properties for over the full asking price. 4 of those properties were multiple offer. They were all multiple offer situations, but 4 of those multiple offer situations had over 6 offers. One of them had 8 and another had 9 offers from other buyers. So it can be competitive, and you should be aware of that. Again, if we go back to Sue's discussion of your pre-qual, of your being able to sit down with a lender and get pre-qualified and feel comfortable and confident, that is going to be a jewel in your arsenal of being of having a promising chance of being that buyer chosen to go forward, because the listing broker on that property and the homeowner on that property want to know, if we get into a situation where you are offering more money than they were listed for, that they can still feel optimistic and confident that you can proceed with the purchase. Next slide, Nicole. We're going to move on to making an offer. What do we need at the time of an offer? We talked about some of the documents that you are indeed going to see at the time that you make an offer. Your real estate person is going to be that person that you sit down and write an offer with. In some service areas, not in mine, not in the area that I work in, but in many of the areas around us, you are signing not just an offer form, but actually a purchase and sale form. So it is indeed the contract for this sale, and you are writing it right at the very beginning. In my service area, we do an offer to purchase. So that is your proposal to a homeowner. It is still a legal and binding contract. You are going to be asked to make an initial deposit at that point in time. It used to be called earnest money, which I think is really a glorious, lovely way to term it. But it is indeed your initial deposit toward the purchase of the home. You will normally make an upfront, write an upfront check for about $500. It's in my service area. It is normally $500 to $1,000. I have taken offers from other agents from other areas, and they will oftentimes bring a check for $100 with an offer. And one of the first things that I tell them as the listing agent is that should we come to an agreement, I will want your client, your buyer, to change their initial deposit check to $500. So there are some functions that are specific to various and sundry selling areas. Again, going back to us talking a little bit about pricing, a price to start. on properties in a very high demand marketplace, such as we are now. And as I understand it, communities around us, I have a friend who lives out in the North Shore of Boston, and the Boston marketplace is as we are, only probably 10 times more more busy, and real estate is disappearing very quickly at very high dollar amounts, and the inventory is very low there. So we will talk again. I spoke a little bit about doing a comparison to past sales in the service area that we're looking in, and of the type and style and condition of the property that you're interested in. And at that stage of the game, we will sit down and talk about where we start with an offer. And part of my job, part of the job of your real estate person, is to advise you on where to start in a heavy duty marketplace. If you want to buy it, and there were three people parked on the road waiting to get in to see the house when we were there, I'm probably going to advise you to come as close to full price as you feel comfortable. However, we can start anywhere. The strength of our offer is oftentimes going to be based on the terms. You have a pre-qualifying letter, a good pre-qualifying letter. You can be flexible in terms of when you can take ownership, and the property is in good condition. So you are asking for nothing to be taken care of by the seller. So in other words, you're buying the property as is until we get to that building inspection. So we start from there. We move on to terms, and I alluded to it a second ago. In the body of our offer is a space for us to talk about terms, and one of those terms is that we will have a 10-day right of inspection and rescission for you to do your building inspection. Throughout that building inspection, we're going to learn various and sundry things about the property that we may not have been disclosed to us, that I might not have known about, and that maybe even the seller doesn't know about either. Most of us don't go down every month and check on our furnace and our hot water heater to make sure that they're in good repair. As long as you turn on the tap and hot water comes out, you're fine. But your building inspector, especially, are very knowledgeable, and they have a system by which they go through all of the systems and all of the points necessary for them to make a determination about the quality of the property that you're interested in. And sometimes we will walk through a property and we will notice something that doesn't seem good to us. That we will be concerned about roof. We may very well come into the kitchen and the tiles in the kitchen are cracked. At this stage of the game, we can indeed introduce some conversation about some of the things that are dissatisfying, that we want to have the seller give attention to. At this in this midsection of terms, we may very well be able to. The appliances are very often included. The kitchen appliances are very often included in the purchase of a home. Your dishwasher is built in, your stove and your refrigerator are part of the kitchen, and you will see them in the listing sheet, and we will be notified that they are indeed included in the purchase of the property. However, oftentimes the washer and dryer are not. And for many buyers, they are kind of hoping that if the washer and dryer is already there, that it will stay with the house. And there's an opportunity for us to ask that the washer and dryer are included in the sale. Sometimes somebody has a hot tub and it's not included in the sale, and you'd like to keep that hot tub. It was part of the draw to this property, and at this stage of the game, we can ask that the hot tub be included. The seller may very well come back to us and say, yes, I'll include the hot tub as long as you include another $4,500. So again, we start responding to counter proposals. We're going to make a proposal, and the seller of that property will come back and counter to us. And again, in terms of purchase price, the terms that we have offered, when can we move in, when can we take possession, and whether or not we want to buy that hot tub. Or they may even come back to us and say, yes, we'll leave the washer and dryer, but you know, they'll raise the price to cover that. Again, I talked a little bit, your offer is a legal and binding contract. So once we have countered back and forth, and sometimes it's a back and forth of a couple of different offers and counter offers before we come to an agreement that works for both the buyer and the seller. Then we will initial all of the changes that we have made to that original offer, and we will get signatures from both of you, from both the buyer and the seller, and we will have a transaction started. We will already have the first deposit, and when the purchase and sale agreement has been produced, and in my service area, your purchase and sale agreement is produced by the seller's attorney, and it is then sent forward to me, I get a copy, and to your attorney, for your attorney to look over first. At that point in time, your attorney may very well make some recommendations and some changes that he or she wants to see, and you will sign first. It will then go back, that purchase and sale agreement, which is our formal agreement, and you need to have one because you're going to take it to the bank. After you have signed, it will be returned to the seller's attorney, and if he or she is comfortable with the changes that your attorney made, then the seller will sign and we will have a transaction. And at that stage of the game, we are going to meet all of the contingencies and the conditions that we have looked for in our offer to purchase. So our building inspection period, and we will hire our building inspector and go right along to a building inspection and do it in a timely, workmanlike manner. We may get to a place where we find through our building inspection that perhaps our roof is not in as good a condition as we hoped for, and we then are going to go back to the seller and want to be compensated for the roof to be repaired or replaced. We may have to have an extension to our building inspection at that point in time because we don't have enough time to get, we probably want an estimate from maybe 2 or 3 roofers. Maybe the seller knows someone and you want to have your own person that you hire and get some estimates. And sometimes it can be a little time consuming to get another expert out to give you an estimate on something that needs to be repaired or replaced, so that you can knowledgeably go back to the seller and we can make another, if you will, counter proposal to this purchase. We still want to buy, but we have just learned that the new roof is going to be $7,500 and we would like you to pay half. We talked a little bit about your first deposit, and then your second deposit is made at the time of the signed purchase and sale agreement. I want to reiterate to you that your deposits are part of your final purchase price, and they are part of your final purchase. So those deposits are going to go against the purchase of the house. We've talked a little bit about your attorney's advice and so on and so forth, and that your attorney is going to represent you and also close the transaction for your lender should need be. One of the things that we haven't talked very much about, because of course we have this gorgeous presentation from Sue regarding your borrowing money to purchase a house, which the lion's share of buyers do utilize a mortgage. For a lot of people, it is a very strong tax benefit for you to have a mortgage. One of the things that I should say to you is if you are indeed going to pay cash for your property, then at the time, even as early as the first offer, as your first day of making your offer, you may be asked by the listing agent, maybe the seller's attorney, or maybe the seller themselves, to provide proof of funds. In other words, to provide proof that you do indeed have the cash on hand that you are proposing to pay for this property with your offer. And that's something that we don't think about very often. But it is indeed something that you should have in your group of documents to provide proof that you can indeed pay cash for this property. Let me just wrap up this purchase a little bit if I can. I think we're probably running pretty strongly on time at this stage, but going toward a closing. So we have met all of the conditions and the contingencies to our offer. We have our closing date all set up. We have decided that we have made a deal to either get the washer and dryer or keep the hot tub or repair the roof. We have had our termite inspection if we wanted one. If we have decided to do a lead paint inspection, that is finished. If you have met your mortgage contingency, your mortgage conditions, and you have a letter of approval with no conditions left on that letter of approval, and your purchase and sale agreement is signed, and then we are ready to go to a closing. And one of the things that happens directly before a closing, we are going to do what we call a final walkthrough, and your attorney is very much going to want you to have seen this property before you come into his or her office and sign your final closing documents and make all of the promises that you're going to make to your lender, or to sign all of your, sign your cash over to your purchase price over to your seller. Your lawyer is going to want you to walk through that property and make sure that it is indeed in the condition that you agreed to in your purchase and sale agreement. So an hour before, 2 hours before, a couple of hours before is really what all of us would like to see. We would all like to see you walk through that property and actually see it and view it before you sign all of those very important documents on your way to your first home. I hope that I've gone through you. Next slide, Nicole. I hope that I've gone through some of the bullet points of shopping for your home. One of the things I haven't spoken to you about is all of the information and so on and so forth that is available to all of us online, and so important and so time-saving. And again, that is very, very valuable. One of the things that I did not talk about, and that was accessibility. And one of the great things about dealing with a real estate person is that the right real estate agent in the right marketplace, and someone who's a little aggressive, especially in a marketplace like this, and wants to make certain that you get into the properties that are indeed available and get an opportunity to see them and find out whether or not they are going to work for you, is very important in this hard marketplace, to make sure that that person gets you, that real estate person gets you in to see those properties. It's my understanding that there is a question and answer period of time, and I look forward to answering any of your questions. And I want to wish you the best on your new home purchase. And I want to thank Nicole and the University of Massachusetts for inviting me to do this first PowerPoint presentation. Thank you so much, and good luck.
Okay, thank you so much, Sue and Diana, for presenting this evening. We do have one question that came through, and the next we're going to wrap up this evening. So the question that came through is, after the last recession, the national average of home prices bottomed out in 2012 and has been rising since. Is there a point at which buying a home is a bad move because the economy will eventually crash again and the value of your new home will be decreasing for the ensuing 4 years?
Diana, is that a question you want to field?
Yeah, I think I'm happy to. I think I'm happy to answer that. I can't. Obviously, I'm not a soothsayer, and I don't have a crystal ball, and neither does anybody else. None of us ever know what's going to happen in the economy. I think that you need to take into consideration, and you know, we're very generic here with our bullet points and so on and so forth. But homeowners, we often, sometimes we forget that home ownership has a kind of intrinsic personal value. If you're shopping for an investment and you're hoping that it is constantly going to grow, and my suspicion is after all of these many years of property ownership myself and in the real estate business, indeed in the long run, and I don't know what defines long run, then real estate in this service area has consistently grown in value. As you have said, along about 2007 and 2008, the debacle that came along changed prices dramatically. No one can make you those kinds of guarantees. The best thing that I could say about all of that is that the house needs to be valuable to you. It is a place where you grow, where perhaps your family grows. It is a place where it is a safety net in a long-term situation. I can't tell you what will happen. To me, a four-year home ownership is not a long-term purchase. You know, if you're going to move in 4 years, and you know you're going to move in 4 years, and you are buying in a very strong marketplace, then that is a judgment call about how comfortable and confident you are, whether or not it's something that you could hold on to if the economy makes some changes, and perhaps rent. In a community such as this 5 College area that I live in, rent is very high. And so oftentimes those mortgages at such really reasonable rates as we have experienced over these last several years from the lenders, a lot of those payments are covered by rental. So there's a lot of points to that. There's a lot of points to that question, and I wish that there was a magic to it. I wish that if I had a crystal ball, that would be a very wonderful thing, but I can't. I have to be a little vague with that answer.
Then we have another question that just came in. If you cannot offer a 20% down payment, is it guaranteed that you'll have to purchase PMI?
Oh, I think I'll take that one, Diana.
Good.
Yeah, on most loan programs, if you don't have 20% down, then you are going to be required to pay private mortgage insurance. But we have seen some variations now. So the traditional private mortgage insurance, you're paying on a monthly with your mortgage payment. Those insurance premiums on a monthly basis are based on your credit score. They're based on your down payment and the type of property, but those premiums are lower. If you may have an option to pay a one-shot mortgage insurance premium at the closing, and not required to pay your private mortgage insurance monthly, but that premium is typically higher. The seller may be able to pay some of that premium, but what it does is eliminate that mortgage insurance from your monthly payment, helping you to qualify for more. And there are even some lender-paid mortgage insurance programs, again, where you're not paying the private mortgage insurance on a monthly basis, but you're somehow paying either in a higher rate. Again, you may not be directly paying the monthly mortgage insurance, but usually without that 20%. And we also have to take into consideration too that on some government loans, you may have, for instance, the FHA loans, you could have private mortgage insurance for the life of that loan. In standard conventional private mortgage insurance, once your equity position has reached just over 20%, so 78%, if your loan balance is 78% of the appraised value, the private mortgage insurance does drop off. So in that case, and if you're there long enough, you're likely better to take a lower rate and pay the private mortgage insurance. Up to currently, and again, we may see this change, I don't want to say with the new tax laws, but the private mortgage insurance, even though it doesn't protect you as a borrower, it protects the bank against the borrower defaulting on the loan. For borrowers that gross income, that their adjusted gross income was $100,000 or less, the private mortgage insurance was tax deductible. And I don't know going forward if that's going to continue, but at least it was something that you could, in addition to the interest that you paid on the mortgage and the real estate taxes, if you're itemizing on your tax return, you could at least utilize that. But I would say in most cases, if you're coming in with less than 20%, that you're going to be required to pay private mortgage insurance. I've seen over the years, not very many, but one option where a 15% down payment. Some lenders will actually do a self-insurance. And again, you may just want to be comparing what the actual interest rate is if you're not required to pay private mortgage insurance. Because, like I said, if the private mortgage insurance drops off and you're there long enough, you maybe have been better to take a lower rate than to take a higher rate that's going to continue for the whole term, just to avoid the private mortgage insurance. Does that answer the question, or if I can clarify, please let me know. Oh,
Yes,
thank you.
Definitely. Yeah, Jeffrey just said thank you so much for the answer.
Thank you. Sure.
So we're actually going to close this evening because we're actually at time. I want to thank everyone for logging in and participating in today's chat, preparing for your first home. Your Alumni Association offers a range of programs, including career and personal development, and ways to stay connected to the university beyond your time on campus. To learn more about our programs, please visit umassalumni.com. On behalf of the UMass Amherst Alumni Association, we would like to thank Sue and Diana for making time to share their insight and knowledge with us. Thank you for joining us this evening. We hope to see you at other Alumni Association events in the future. Have a great evening and go UMass.